we've seen some healthy signs of life in the M&A sector. We think that conditions are such that it could be a promising year for M&A activity, but again, a lot of it depends on the uncertainty with some of the policies that will be adopted with the Trump administration, as well as how the Fed will react with interest rate cuts.
I'm here today with Greg Cope, partner at Vinson Elkins. In the current environment of political change, what are key issues for REITs to consider on the regulatory front?
I think the most important one that people have been focused on is tax policy with the new Trump administration. There's a greater belief that the Tax Cuts and Jobs Act tax cuts will be extended with President Trump now in office, which should be beneficial to REITs, especially the extension of the individual tax cuts, which, if had been allowed to lapse, could have been harmful to REITs as compared to C Corps. Even if the corporate level tax is reduced to 20% from 21%, it still wouldn't materially impact REITs. We also see a few different potential changes coming from the SEC. I think that the SEC climate disclosure laws will likely not go into effect. However, that's not cause for too much celebration because the California laws still will go into effect. So a lot of REITs will be impacted with having to comply with those disclosure rules. We also expect that there could be some changes at the SEC to encourage new capital formation, especially around private capital raising. Some of those rules could be eased.
And how would you describe the capital market backdrop for REITs today? And how active do you think the sector will be on the debt and equity front?
The market has been stronger this past year than it has been the couple of years prior. We're cautiously optimistic that it will continue to improve in 2025. However, as with any kind of forecast, it's inherently uncertain what's going to happen. Just a couple of months ago, it looked like the Fed was going to continue to decrease interest rates pretty substantially, which in our view would improve the access to capital, especially on the equity side and on the debt side. However, with some of the proposals that President Trump has mentioned, some of those could be inflationary in nature, and that could cause the Fed to keep rates higher for longer. So we're cautiously optimistic that the environment will continue to improve, especially as transactional activity in the real estate sector increases. But I think it's still too early to tell.
And which REIT sectors do you see as having the most potential for M&A activity in the year ahead?
Yeah, so we're excited about the potential for more M&A activity this year. We've seen some healthy signs of life in the M&A sector. We think that conditions are such that it could be a promising year for M&A activity, but again, a lot of it depends on the uncertainty with some of the policies that will be adopted with the Trump administration, as well as how the Fed will react with interest rate cuts. But we've seen a lot of activity and expect to continue to seeing activity in the retail sector, both the multi-tenant and the net lease REITs. There's a lot of data center activity out there and expect that to continue to increase. We also see healthcare, multifamily, all across multifamily, residential, manufactured housing, and we've also seen some self-storage activity, and those are the ones that we think that are most likely to continue in the next year.